Okay, it gives me great pleasure to bring on board Anish Shah, Managing Director and Group CFO with Mahindra & Mahindra. Mr. Shah, good morning. Thank you for joining us. I'm officially welcoming you with your new designation. So it's great to welcome you with your new designation, and let's take the conversation forward from there.
Good morning. It's a pleasure to be here, and thank you. Good morning. It's a pleasure.
Mr. Shah, the first question has to be the obvious one, something which we were not prepared for, something boardrooms were not planning, something boardrooms never thought that would emerge so strongly, which is the second wave. How has that impacted your company's business, sentiment, and planning?
So at this point, the impact is not very significant. The government has been very prudent in terms of how it is handling the situation right now. We are seeing, in some sense, a lockdown on everything outside economic activity. Some of it may cover some economic activity, but at least factories for all companies, whether they are large or small, are running for the most part. And that is important. That keeps the workers in play in the sense that they're not impacted. It keeps some migrant workers in the factories as well. And therefore, that's been a very important step and a key difference between what we saw last year and this year. It will remain to be seen how the situation goes forward. It is a grim situation. And I heard you're urging all the viewers to stay safe. That's something that we believe in. The vaccination will help a lot. Today, of all our workers who are eligible for vaccination, 90% have been vaccinated already. In the next couple of days, we should be at 100%. And we have been urging the government to open it up to all workers and all frontline folks that include people at the frontline of the economy to be fully vaccinated, even below the age of 45. So if that happens, then we will be even safer, and that at least puts the economy on a good track.
Are you in favor of a semi-lockdown or any kind of a lockdown at a state level? I'm not trying to draw you at a towards political water, sir, but I'm trying to understand from you that does it make sense to implement a lockdown or a lockdown of any sort, whether it is semi or full, whether it is at state level or whether it is at in a couple of states, it's going to hurt the economy very badly?
I think this is a question that is a very difficult one because it goes back to lives versus livelihood. And we've got to find a way to keep the economy running, at the same time protect lives. The numbers that we see today are far higher than what we've seen even in the first wave. And therefore, I think the government has a very difficult dilemma on hand. And they have to take certain actions because protecting lives is important. The question is, how are those actions set up? Where, if I were to look at it as concentric circles, the first concentric circle is keeping the workers safe, keeping our masses protected from an economic standpoint. And if that is done, then that helps the masses and that helps balance lives and livelihood. Now, at which concentric circle do you draw the line? That I would leave to the experts to decide. But there has to be some action taken. At the same time, we have to protect livelihood.
Okay. While preparing for our today's interaction, I was scanning through research notes, and a research note from CLSA has hit my mailbox, and it talks about factors why the Mahindra & Mahindra stock off late has underperformed Nifty. While it outperformed for 2020, first half it is underperforming. And one concern, which in a sense is a common concern, which I'm getting from some industry observers also, is that the tractor business has peaked out and last year's base effect would kick in, and now it will be difficult for the tractor industry to grow in double digit. Is the concern valid?
So the tractor industry has always been cyclical to some extent. We've seen a very significant growth last year, about 20% year over year. We don't expect that 20% growth again. But at the same time, the base is much higher today. We would expect a single-digit growth this year, not a double-digit growth. But beyond tractor, there are many more growth levers. If you look at farm machinery, for example, farm machinery globally is 2x tractors. In India, it is a very small fraction of what is sold as tractors. For us, 5% of our tractor sales is what we sell as farm machinery. And therefore, we see a significant growth potential in that area as well. So I would say two things. One is the tractor base being higher obviously helps us significantly, even if it's a single-digit growth rate. And if you add to that the potential with farm machinery and some of the other areas we are seeing, we see a fairly strong growth trajectory for us.
Okay. So what you are confirming to us, or perhaps what you're sharing to us, is that you are still confident that the tractor industry will grow in double digit. I don't want to get this one wrong, sir, because it's a price sensitive question.
At this point, from an industry standpoint, we don't expect a double digit growth rate. We'd expect a single digit growth rate this year.
Okay. Capital allocation, something which has been the differentiating factor for last couple of quarters for Mahindra and Mahindra. Lot of good work in the international subsidiaries has already happened. You have surprised and delighted the markets and your shareholders with the kind of capital allocation plan which you've shared and with what you've implemented. What is next? Do you think the low-hanging fruits have been plucked already, whether it is for the US business or for Sangyon, and now it will be difficult to keep on churning out this kind of an efficiency?
There's been a tremendous set of actions taken last year. And what we have told our analysts and investors is that we had seen losses of 3,000 to 3,500 crores from our international subsidiaries. That will be down to 300 crores this year and get into positive territory soon after that. So that significant turnaround has already happened. And we are now therefore focused on growth. We've got a number of different growth engines, and we feel that that will really take us to a very different level.
Exciting times, Anish. The EV segment, I'm curious about that as well in terms of the kind of investment, but also the strategy on that front and how you feel some of the larger auto companies like yourselves will actually take this head on and and devise a plan for the future.
So on EV, we've been the leader for many years, and even today, if you were to include the last mile mobility, we sell more electric vehicles than anyone else in the country. We see this happening in two phases. Phase one is around the last mile mobility, which is the three-wheelers and smaller four-wheelers focused on load as well as passenger. For that segment, the cost of ownership is better than conventional vehicles. There is no range anxiety because they have the range that they need. And infrastructure is not really as relevant because these are smaller batteries that can be taken out, swapped, or charged anywhere. So that makes it much easier. And therefore, we see that segment really taking off. And over the next 2 years, we see a much faster adoption of electric three-wheelers. And we've got some very good set of products there. The second one is four-wheelers. That's going to be a slightly longer term story. I would say 3 to 5 years is a fair horizon for it to really start coming into its own, because there the cost of ownership is really not as good as yet. And we still have to do more work on being able to charge faster, on being able to provide the infrastructure that buyers will need. So all of those things will come together, but that will take about 3 to 5 years.
And the kind of investment you're looking at, some reports suggest 3,000 crores over the next 3 years?
That's correct. So we have committed to 3,000 crores in the next 3 years, and we will continue to evaluate what's required further beyond that as we go through the first phase.
Understand that the company has big bang full refresh of the XUV 500 and the Scorpio as well in the current year. In terms of the kind of outlook you have for market share when it comes to this particular segment and the SUV front, how's that looking? How excited are you about the prospects there, and what do you think is a realistic expectation?
So very excited on that front right now. We have great success in the Thar. We are seeing just a very high level of bookings, even as there is a longer wait period because the level of bookings is far higher than what we'd expected. The XUV 300 is also doing extremely well, and that has ramped up quite significantly. In addition to that, the new launch that's expected of the 700 is an exciting one. And then, as you said, a Scorpio refresh that comes in after that. So we've got 4 very strong products, two that are in play already and 2 that are upcoming. And that should put us in a very good position.
Anish, the focus on capital allocation, which you earlier as well mentioned, will that continue to be the key and the main focus? And will benefits of change be visible in FY23 onwards itself on your ROE?
So the benefits will be visible from this year because, as I mentioned earlier, we've taken a significant amount of losses out of our P&L. And from a capital allocation standpoint, the fiscal discipline will continue. But in terms of exits, that's behind us because we've done a very detailed set of analysis and we've taken all the actions required and multiple exits across companies. So that is behind us now, but the discipline will continue to stay. We will see the benefits starting this year and continuing forward as well.
A slightly micro topic, but wanted to understand how is it that you're viewing this entire commodity price uptick and how that's going to, impact your businesses across the board?
We have seen a very significant rise, and that is a function of demand globally as well as some supply chain challenges. We see some of that easing out once supply chain challenges go away. But it is a concern right now. Margins will be impacted across the industry. For us, we are better positioned because we've historically had far higher margins on the tractor side. And in auto, we've been among the higher side as well. So from that perspective, we are better positioned than many of the other players. But we see that as an impact on the industry.
But at what point in time, Mr. Shah, you think the ability for auto companies to keep on passing on the price hike would be limited? Right now, steel companies are increasing prices, auto companies are passing it on. There has to be a threshold where either steel prices or commodity prices have to come down, or customer will say, look, I cannot accept it.
So at this stage, the increase in commodity prices has been so significant that, frankly, I'd be very surprised if that increase continues. So we shall have to wait and watch as to what happens. But you're right, there is a limited ability to pass pricing on to consumers. And one can debate whether we have reached that already, whether there's still some room. But I think the bigger point is around where commodity prices will go. And as we've seen the very dramatic increase so far, it's difficult to believe that that will continue to go up.
So what should we expect at the P&L level? Commodity prices, they go higher, top line automatically will go higher, price hike will happen. But at the bottom line, margins, will there be a contraction?
So we've seen commodity prices go up through all of last year, and it started, in fact, a little more than 12 months ago. And from a margin standpoint, we managed to actually do better than expected as well because of various other actions that we've done to take out costs in the system without impacting our employees. And that has helped a lot. Those cost savings will continue into this year and beyond. And that's been one way for us to mitigate the impact of higher commodity prices.
Okay. We're just shifting the scope of our interview from micros to the big picture, and I'll go back to the big picture once again. The most important differentiating factor, sir, is the capital allocation. We've discussed 2 questions on it, but I'll try to be very specific here. The capital allocation changes at Mahindra and Mahindra level, which is your auto business and international subsidiaries. Work in progress, great news. Which are the other group companies where you think the capital allocation changes would be as significant what you've done, let's say, with a Sangyon or with your other international businesses?
So on that front, even beyond international subsidiaries, we looked at all loss-making entities in India and have taken action there as well. So that is behind us. What we do see now is a huge potential for growth. And let me outline the growth engines that I briefly referred to. If you were to look at our core businesses, Auto, Farm, Tech Mahindra, and Mahindra Finance, all 4 are very well positioned in their industries. And each of them has a set of things that can really drive growth for them that we are starting to see play out. Beyond that, if you were to look at a set of companies like logistics, holidays, real estate, they've got potential to grow very significantly from where they are today. They're all listed entities and have the potential to be $1 billion market capital in the next 5 years or so. And then we've got our growth gems. Growth gems are 10 companies that have a cumulative revenue of 10,000 crores last year, and many of them are profitable and can be scaled up significantly. We will see some $1 billion market cap entities coming out of the growth gems as well. So that gives us multiple engines to play with from a growth perspective. So at this stage, returns, we are on a very good track, and we are really putting all our efforts behind driving growth across these companies to have a very healthy growth rate for M&M overall.
For the group companies, Mr. Shah, let's say Mahindra Finance or Tech
Yes.
Mahindra, they are, right, I'm talking about, let's say, two specific cases here, Mahindra and Mahindra Financials and Tech Mahindra. These are great companies, built to last. But if I look at the industry matrix, let's say the NIMs or the margins which Mahindra and Mahindra Financial has enjoyed in the past versus if I compare with industry peers, and even Tech Mahindra, great brand, had a great advantage with AT&T, but if I look at the margins, what they have reported for last couple of quarters, they are not the best in the industry, not even second or third. Are there any specific plans for these two companies?
So both play in segments that are slightly different from their industries. If you look at Mahindra Finance, it's the largest player in rural India. You've got a set of customers that are not salaried. And that, therefore, is very different comparison with other financial companies that go after a higher percentage of salaried customers. So what we have seen in the past is whenever there are issues in an economy standpoint, Mahindra Finance has had higher NPAs, and the credit losses have never been very high. But it's the NPAs in the short term that are higher, they come back to normal, and Mahindra Finance has come back strong after every such occurrence. And that's what we would expect this round as well. Tech Mahindra has been more focused on telecom over many years, and it has been transforming itself over the last couple of years, and therefore has shown much better performance than many of its peers. So it's on a good trajectory right now, and we do expect that trajectory to continue.
Okay, fair enough. All right. In terms of, the challenges also, Anish, of really implementing some of this at a time like this, and I know we've spoken about it, but going forward in terms of the kind of plan that you have in place and the strategy from a slightly more bird's eye perspective that you have now in this current role going forward, is it really just taking forward some of what was already in play? Is there also a fresh perspective or new angles that you're exploring, perhaps even if it's within key segments? And anything that you'd like to share with us in terms of really how one could build on whatever has already been in place?
So we've taken a very different view last year from a capital allocation standpoint, and the board has been very supportive in taking all those actions. So from my perspective, I see myself as fortunate to start this role with a number of difficult actions already behind us. Where we will focus on this year is really on growth. We will look at different perspectives. We will look at creating platforms in some cases. Our used car business is very well suited for a platform in used cars. Leveraging digital and technology in a much bigger way is going to be a focus. So those are the things that you can see as we drive this growth.
Okay, fair enough. And in terms of the kind of growth momentum that you see from an industry point of view as well, given the kind of headwinds that we're facing, not just from a company perspective, but from an industry perspective, give us a scenario over the next 2-3 years and whether or not you actually see a longer term impact of what we've actually been through. Some segments have come through this, performed, given us a reason to be positive. But in the longer term, how do you see the impact playing out?
So I'm very optimistic on it, even based on what we've seen in the last 3 or 4 months, or even through the last year, for example. Rural India has been a very strong positive story, and we see that continuing. If you were to look at IT services, that industry has been doing well on the back of demand for a number of different reasons. And there again, we see that continuing. Holidays has done well even in a tough year. And the last 3 to 4 months before the second wave, we just saw all our customers coming back. And therefore, I do feel that as we get out of the second wave, we should be much better positioned. It's going to be a lot better than what most would expect.
Anish, I have to ask you what you told our colleagues at the Economic Times, that you may be applying for a banking license and you're confident of meeting all standards. Is the war room ready? At what stage of preparation are you currently at?
So the basic message is that we remain interested, but it would depend on what the RBI guidelines and regulations are. So at this point in time, we are waiting for them. My basic comment was that from a governance standpoint, we have a very high standard. So any guidelines around governance, we will of course meet. And there are other considerations as well. So we have to see what those considerations are. And when the guidelines come out, at that point, we'll be able to react to that in terms of whether we can meet it or not.
Right. You think that, having a presence of a focused bank is now the extension to the Mahindra group and sort of fits the bill and makes the bouquet a complete whole?
It's one that is, in a sense, a logical next step, but it's not something that's essential in terms of making the bouquet whole. So, as I said, if the regulations allow us, that's something we would stay interested in. But we have a very good set of businesses today that are very well poised for growth. So, I'm very happy with the bouquet that we have right now.
Thank you. It's great to have you on the show, and thank you for taking the time out and speaking with us at ET Now.